Okay, so good evening, everyone. Thank you for joining us tonight for the third part in our Get It Done series, where we take important topics to share with the community and provide you with information to help you make key decisions based on your own situation. So clearly, I'm not your usual host, Jason Lamb. He can't join us tonight as he is actually back in Sydney visiting some family, but this allows me to introduce myself. My name is Stephen, and I am the Business Development Manager for JL. We are an Australian mortgage brokering company based here in Hong Kong to help Australians and families looking to move to Australia sort out their financial needs. We have been the go-to expat mortgage brokers since 2017 and the longest dedicated brokers here in Hong Kong. Jason himself has been in banking and finance for 20 years. And just a little bit about myself, I'm also from Sydney. I've got a background in Australian tax for about 10 years, and I moved to mortgage broking business last year. So we approach our clients' finances holistically, and as such, we work with other incredible professionals who have similar values and principles with strong knowledge of the Australian market. Specifically, we choose to work with experts who have exposure in Asia, as well as Australia, because our expat clients and their families here have specific needs and have available to them a vast range of financial tools that they can only be accessed through those with acquired knowledge, such as previous speakers and of course our panelists. Before we jump into the introductions, just some housekeeping items. We will do our best to finish by 8:30, so it's just past 7 at the moment, so about an hour and a half. We will have the presentations from our guest speakers followed by a Q&A at the end. At the bottom of your Zoom window, there should be a Q&A button, which you can send questions to the panelists here tonight. So as you listen along, have any questions, please send them through so that we can get them answered for you. This webinar will also be recorded and you'll be given links to the download so that you can re-listen at your own leisure shortly after. So our first guest speaker tonight is Janu from Bite Size Economics. She has been economist for various banks for over a decade, and most recently within the economics team at the Westpac Group. With this experience, she has a keen eye in assessing financial markets and providing insights into key economic issues. So I'll hand it over to the webinar to Janu to take us from here.
Thanks so much for that, Stephen. So I've been in Hong Kong for a bit over a year now, but I was from Australia as well. Born in Australia, grew up there. And as Stephen mentioned, I worked at Westpac for around 10 years, most recently, covering Australia and focusing on currencies and Australia, of course. At the moment, I'm conducting freelance work and providing independent economic content. And that includes a newsletter which focuses on economic issues globally and on the Asia Pacific region, which all of you are free to subscribe. I aim to make my content very easy to understand for everyday people and which will hopefully be relevant to you. And I'll provide details at the end if you are interested. So today, first of all, a quick disclaimer to remind you that everything I say here today is just general advice and doesn't reflect your personal circumstances. I no longer have a compliance department watching over me at the bank, but I still need to watch my back. So being at the beginning of another year, it tends to be that time when we reflect back on the year that was, and all the forecasters come out and predict what's going to happen in the year ahead. Today, I do intend to do a bit of crystal ball gazing, but it is mostly about highlighting the key issues that is going to face the economy and financial markets that you should be watching out for in 2022. I'll then focus on Australia and see how that fits in with the global picture. And then, of course, talk about interest rates and that outlook and the Australian dollar. If you have any questions, as Steve mentioned, there is the Q&A box. I am happy to take questions throughout my presentation. So I will pause in a moment of my presentation just to see if there are any questions, and I can just take them as we go along. Now, the global economy, most major economies have now fully recovered from that big downturn that we saw in early 2020. If you think back to 2020, we can think of it as when the whole world locked down. I was just talking about that time with Matt, thinking how long ago that was. I guess it was 2 years ago when everything was literally locked down and the whole world entered a very deep recession. So you think of 2020 as that year of that lockdown. 2021 was about recovery from that lockdown. Looking forward to 2022, we're not going to see the same sort of growth as we saw last year, just because we're not coming out having that major gain from that reopening of economies. The IMF estimates put economic growth last year at well over 5%. In 2022, we're probably looking, the latest forecast was at 4.9%. We do get an update, which is actually due out today. I suspect that it might be a little bit weaker than that, but just to give you an indication, it's not going to be the same kind of growth as we saw last year, but for the moment, it looks like there is some pretty healthy growth in the year ahead. A lot of risks to that outlook, and we'll discuss that in today's talk. COVID is still playing a big part in that economic outlook. It's because of COVID that Australia had those restrictions put into place in the third quarter of last year. And we did see quite a significant contraction in economic output. Moving forward from that, in Q4 and into this year, we do expect that we'll see some rebound from that. Although the Omicron wave, which is currently underway, it could dent some of that recovery. So still some uneven growth throughout economies, largely because COVID is still affecting the world economy. And so that brings us to the first issue that I would like to discuss, and that is COVID-19. And the Omicron wave is a major reminder of how much COVID-19 is still affecting the world. And there is still that risk with that surge in Omicron cases. It's going to impact on demand over the beginning of the year. And now there are some silver linings with Omicron. Firstly, with all of these COVID waves, once we've recovered from that wave, demand has shown to recover very quickly. And each time a wave has occurred in various countries, that impact on demand has been less pronounced each time. Now, Australia hasn't really had much of a COVID wave. Because it's been tempered by those lockdowns. And so having this new strategy of letting it rip, as they call it, as they're saying down there, that once past this is probably, hopefully, the worst wave that it's going to be. Look, there's a lot of uncertainty about COVID. Positive things that we can say about Omicron. First, that it's supposed to cause less severe disease, even though it is more contagious. And a lot of us now vaccinated and highly vaccinated in Australia, and the world is more vaccinated. It is worth pointing out, though, that not the whole world is highly vaccinated, as the chart on the right shows, and particularly with the lower income countries, there is still quite low vaccination rates, which highlights the risk that we're still going to see COVID prevalent in the world, the risk of other variants emerging, meaning restrictions on activity, people into quarantine and that sort of thing. If you think about the way the countries, the mismatch in the developed countries and the less developed countries, and the ones which are vaccinated and not, which ones aren't. If you have to think about that mismatch, it has really affected the dynamics within the global economy, because it's those advanced economies where demand is likely to be stronger, but it's those emerging and developing economies which are those ones which tend to provide raw materials and manufactured goods for the rest of the world. And so this is one big reason why we're seeing these supply constraints in the world. So while there is COVID still in the world, we're likely to still see these supply constraints continue a while longer. So upon reopening from restrictions from COVID, demand was very strong. At the same time, supply for all the things that we were demanding was restricted because of COVID, and that was still impacting on production. Last year, there were a lot of news reports about energy being one area where constraints were quite prevalent. In Europe, they had very high gas prices. In China, there was electricity rationing and blackouts. And at the moment, we're not seeing the same sort of reports on shortages. There's still quite tight supply and still quite high prices for some of these resources. The other constraints that have been obvious, which is semiconductors, which goes into all things electronic, like cars, iPhones, etc. That's also still very high. And within shipping as well, so you can see the container index that measures the pricing for containers is also still very high. That Baltic Dry Index, that's actually come off a little bit. I suspect that has to do with iron ore and coal, which are inputs to steel, that coming off because of falling production in China. And I will go into that in more detail in a minute, but that's one interesting development there, that that pocket is actually has seen some of those supply constraints ease there, or at least prices ease there. Now, there's a lot of reasons specifically to why we're seeing these shortages develop, but more broadly, we are seeing steel prices very high for a range of raw materials and commodities, and not just the ones I've shown here and discussed, but also metals and agricultural commodities. And so these higher prices have been reflected in higher rates of inflation. And we really haven't seen inflation as an issue for a really long time, at least 30 or 40 years or so. So it is a really unique environment for financial markets and the economy, because it's not something we've seen before in a very long time. There is a comment from, there's a US comedian called Trevor Noah who said that inflation is that one concept that real people actually care about, because it's affecting what their purchasing power, what they can buy, and it's essentially shrinking their real incomes. So it means it becomes a political issue and an issue for everyday people on the ground. So very high in the US, it's at 7%, annual rate of 7%, highest in 39 years. In Germany and the UK, they're also at multi-year highs. In Australia, it isn't as high, currently at 3.5% in annual rate, but it is still high. That's above the RBA's target. And more importantly, when we strip out all of those volatile items and we look at core inflation, we look at more an underlying trend of inflation, that is at 2.6%, which doesn't sound as high, but that is the highest in 7.5 years. And one of the reasons why I think Australia's inflation is not as high as other countries around the world is because Sydney and Melbourne had those quite strict lockdowns towards the end of second half of last year. And I think that kept down prices for, I think, the Q3, and the latest data we got just today was Q4, and that was very strong. So even though we can use comparisons to the 70s, it isn't quite like the 70s. And so while we have things like flared jeans making a comeback, we're still in a very different inflationary environment today. Many differences, but one of the main differences that I see is that in the 70s, inflation was largely reflective of an oil supply shock. and demand was very weak. But today it is both I think a supply and demand issue. Yes, there's a supply issue because the world isn't producing enough to meet demand, but it is also largely a demand issue because of the surge in demand coming out of those COVID lockdowns. So rising inflation means rising interest rates, and the Federal Reserve is flagged to now looking to raise interest rates this year. The Federal Reserve itself, they are expecting around 25 basis point hikes this year. And financial markets are pricing a little bit more now. They're pricing in about 4 hikes this year. And it's a real turnaround in the past couple of months. The Fed has, for much of last year, viewed inflation as something being transitory because it's been due to COVID, and COVID is seen as a transitory thing. But it has been with us for a pretty long time now, over 2 years. Where does a central bank step in and go, okay, look, inflation is probably high inflation is going to be a bit long lasting than what we previously expected. So recently, the Fed finally conceded that that was the case and said that it was about time we dropped the term transitory in describing inflation. They could begin hiking as soon as March, which wouldn't be out of the question. And whether they hike 3 or 4, the main point is that the Fed has signalled that it is ready to begin its tightening cycle, and that process of withdrawing all that stimulus that has been put in place since the pandemic, that they're ready to pull that back. And that's partly why you are seeing, a big reason why you're seeing that carnage that we saw in equity markets over the past week, and just concerns about what tighter monetary policy means for financial markets when we've had all these years of extremely easy and stimulatory monetary policy for quite some time. The fourth issue is the US dollar, which is very reflective of what the Federal Reserve does. It's also very important in the world because it impacts financial flows around the world quite significantly. Fed tightening does tend to lend towards US dollar strength, but we've also seen a lot of this tightening cycle now factored into the US dollar. In fact, it probably may have seen a peak early January, beginning of this year, or late December. And we might see the US dollar still in this high period, but I tend to think that we probably have seen that peak occur in the US dollar now. Let's not rule out that risk that the US dollar could strengthen further. And the reason I say that is because if the Fed does decide to pursue a lot more aggressive monetary policy, we actually see a sharper downturn in the global economy, say perhaps if inflation does end up being a lot stronger than what we expect, and central banks do step on the brakes more on monetary policy, you could get like a sharper slowdown expected in financial markets. That could be US dollar positive. But those scenarios are not a base case. It's just more about highlighting those risks. And the reason why we want to highlight this risk, because when a US dollar strengthens, it places pressure on emerging markets because it means that stronger US dollar means that their currencies, emerging market currencies, tend to depreciate. And one of the reasons why you see problems in, say, Turkey, along with their own ridiculous economic policies, but a stronger US dollar gives rise to expose some of these economic problems within emerging market. If you take a look at if you take a look at this chart, it's a little bit confusing to it. It tracks the relative performance of emerging markets to the world index, and that's charted with the US dollar on an inverse scale. So it means that the stronger the US dollar, the less well emerging markets perform compared to the world. You see that's actually diverged a little bit towards the end. So we've seen some very strong underperformance from emerging markets, even more so than what the US dollar value might be implying. And I think that's a big reason is because of Asia markets in particular. The Asian equities have performed quite badly. And that brings us to number 5, China. And this is probably one key risk for the global economy, and in particular, the troubles in the property sector. In the past few months, I have to say the situation has gotten worse. We all know about Evergrande, and its operations have essentially been taken over by the government. And if Evergrande were domiciled in another country, say Australia, US or Europe, or actually anywhere else, Evergrande would more than likely enter bankruptcy proceedings, and they will work out who gets what in their claim of asset. But that hasn't happened. It's the government, and so there's not a lot of transparency about who gets what, to the point where investors could potentially take some legal action. Recent news is suggesting that they're going to work something out, but I think it does highlight the fact that they had to do that. There's a lot of uncertainty there should be a lot of uncertainty among offshore investors about the corporate bonds and that process if it does need to go to default. And I guess the potential for the government just to take over and do whatever they want. Other developers have been in trouble too, including ones which are seen in better shape. And that's unsurprising given that uncertainty facing investors and the systemic issues which is in the sector. One thing which has been a little puzzling, which was a little puzzling to me, is that if you look at the broader financial sector, it hasn't really been affected, particularly in corporate bonds or so there's basically not a lot of signs of financial stress in the broader financial sector. And I think that reflects that really strong confidence authorities are going to step in to prevent wider contagion. I would still say that there's still some firstly, because there's hidden debt of those developers that we don't know about. There could be some flow-on impacts to other sectors, particularly the local government, and that relies a lot from land sales for their revenue, and they also hold a lot of debt. And there's that potential economic impact, which has already led to some decline in cement and steel production, which could mean job losses. We could see some further declines or sharper declines in property prices, which means households will see this big drop in wealth, which would lead to weaker consumption. The flip side, though, is that authorities have really changed their tune about what to do about their economy. They're clearly very worried about what's going on and the outlook. So there's been this big shift about, okay, look, we need to now support the economy. They haven't done much in the way of monetary policy. They've only increased interest rates a little bit. I suspect there'll be more to come. The stimulus is going to come through in terms of infrastructure spending mostly, and they might end up loosening the restrictions on local governments and perhaps even the property developers. It does seem like they have completely done a 180 in terms of how they want to treat the whole crisis, and they're very worried about economic growth now. So that just means they'll probably pump up the stimulus, and I don't think we can underestimate what that stimulus can do for China and for the world economy. Might kick the can down the road in terms of their issue with debt, but I guess it's the same issue could be said for everywhere else around the world. Okay, I might stop there and see if there are any questions in the chat, or is there any, Stephen? Okay. All right, so Australia, we do. Okay, from Joe Bell, thanks Joe. How confident are you of interest rising? I'm saying interest rates. I'm very confident it's going to happen. No doubt about it. It's a matter of when and how much. I did discuss the US. They've got, as I said, three expected by the Federal Reserve and 4 expected by financial markets. And like that wouldn't be too far off the mark, I think. In Australia, it's going to happen too. And I'll outline why that is the case in a moment. Yeah. So what about Australia? And these are pictures giving me a bit of nostalgia, hanging out at Opera Bar, outside, with people.
Australia tomorrow as well.
Yeah. And, oh, yes, of course. And Australia Day. So a lot of the issues globally that I've discussed are also affecting Australia. And I will make special mention of the supply constraints. For the second half of last year, there was an argument that was strongly advocated by the RBA that Australia was different when it came to inflation and we wouldn't face the same sort of upward pressures as other advanced economies in the world. Now, Australia's inflation is a bit lower than everywhere else in the world, other advanced economies in the world, but I don't know if that argument is looking very strong now. I think it's wearing pretty thin, particularly now that Omicron has been allowed to let go in the community. So first of all, you've got the constraints internationally that are affecting shipping, oil prices and other commodities. So good in particular, prices of goods that's been affected. But domestically, there's also signs as well. And you can see that firms, in business surveys, firms are reporting that availability of labour as a constraint to output is the highest or near the highest in the survey's history. And also the availability of suitable materials, that's also highest as well in the survey's history. And that survey, I believe, was even done before. So you can imagine that should look even worse if you saw that in an update now in a survey, because now we're seeing supermarket shelves emptied, and the reports, other reports are suggesting that there is this big, it is reflecting this shortage of workers because all these workers have had to go on quarantine because of COVID, or they're off sick. And this was one of the major factors which led to higher inflation in, say, the UK and the US. So it just seems inevitable that it's going to happen in Australia as well. The other sign which would suggest that inflation is set to pick up is wages. Now, wage growth isn't all that strong at the moment. It's at 2.2%. But when you have all of those reports of labour constraints, you've got borders restricted so they don't have migrants coming in. That's another factor. Omicron, meaning a lot of workers not within the labour force anymore, they're at home. So that shortage of workers is certainly going to put that upward pressure on inflation. And another sign of that tightness of that labour market is the unemployment rate, which is now at 4.2%. And with the economy potentially strengthening post-Omicron, there's that likelihood that is even going to go lower even still. And that unemployment rate at 4.2%, I can't even remember. It was last time that was that low. I think we have to go before the GFC to see the unemployment rate actually that low. So all of these signs are actually pointing to inflation picking up, and not only just picking up, but also that persistent kind, like a sustained increase in inflation. What's important is wage growth has been seen as important for policymakers in determining whether we see that price increase, temporary price increase or price increases which are more longer lasting. So watching this wages growth is going to be critical in determining just how much the RBA may want to tighten. I've spoken a lot about supply being constrained, but here's a chart which is showing just the potential for demand to be strong as well. So on top of the demand from opening up from there's just been this great deal of stimulus through those household incomes because of the government support that's been put through because of those lockdowns. JobKeeper has been the biggest one. They put out another one in the lockdown Mark II, the second half of last year. So you can see that spike in household income because of that stimulus from the government. So this is potential money that households can spend later on down the track, because throughout those lockdowns you see actual consumption falling off quite sharply, because throughout the lockdowns people just aren't spending as much. They're not going on holidays, no big nights out at the bar, so you've got this savings which has built up, which means there's this big potential for households to do something with that money and spend more of it when they actually can. So the source says that interest rates are likely to rise sooner rather than later. Now, the RBA itself has played down the likelihood of a rate hike this year, but given Omicron and given the latest inflation data that was just released today, conditions are really building up that the RBA won't really have a choice but to raise rates this year. So if we have a look at the conditions that the RBA presented to us before raising rates, they said that they wanted to see inflation to be sustainably within the 2 to 3% target band, and it wanted to see wages at least 3%. Now, if you think back to those charts I've showed you before, look, inflation is clearly within 2 to 3%. We've had underlying inflation within 2 to 3% for 2 consecutive quarters now, and it is the odds are that's also going to pick up. We've also very likely to see that wages growth pick up to 3%. It's just a matter of how quickly that's going to happen. But given where inflation is sitting, we're pretty close to meeting those requirements. It's just wages aren't actually there, but they're very likely to get there. And it's possible that we could even see that wages with a 3 in front this year sometime, at the earliest probably middle of this year. So look, financial markets are thinking a bit differently to the RBA. They're expecting 90 basis points of hikes. And I think in this scenario, markets are probably a bit closer to the mark than the RBA for what might actually happen. I would say that a baseline forecast would be to see rates to hike, for the RBA to hike at least 2 or 3 times this year. Yeah, look, the inflation outlook is just all pointing to the RBA needing to do that. Worth pointing out that even if the cash rate hasn't actually moved yet, bond yields have moved quite significantly, which means that a lot of those longer term interest rates are already rising, and they affect those fixed rates that you can get in the market for your home loan or your business if you're on a fixed rate. And so expectations for high interest rates, relatively higher commodity prices have meant that most fair value models would put the Aussie dollar a lot higher than what it actually is. It's actually diverged quite significantly over the past year or so. My thoughts behind that divergence is because of that view that initially, because commodity prices were probably not expected to stay as high as they have for as long as they have. Also, Another reason is that China is looking a little shaky, so that might add to that uncertainty. And plus, there's a lot of risk sentiment is actually pretty weak at the moment. That's probably kept the Australian dollar quite lower than what models might suggest. I would expect the Australian dollar to head higher with the Australian dollar, with commodity prices still staying high, and the likelihood that the RBA will raise. But we do have some factors which might temper that potential appreciation. That's those ongoing risks in China, although I do think they've turned a corner in providing stimulus there. The US tightening rates, and if the Fed does decide to become more aggressive and markets become a bit even more jittery than what they are, then that could weigh on the Aussie. But otherwise, I would put the Aussie in the mid to high 70s for the end of this year. Now that just about wraps up my talk. I think I've talked a bit longer than what I thought I would, but so I won't go over, rehash what I've spoken, but I'll leave it to Steve to move on to what comes next.
Okay, so thank you, Janu, for that presentation. That was very insightful. Please feel free to add some questions using the Q&A button, and we'll have Janu back on later just to answer them for you. So our final two guest speakers from the team at Oriana Financial Services to touch on some of the things that Janu has spoken about and also some investment strategies for this year. So firstly, we'll bring on Matthew Jones, who is a senior wealth advisor with Oriana. Matt has over 10 years experience in financial services and specializes in delivering comprehensive advice for expats throughout Asia and those returning to Australia. He's been living in Hong Kong for 5 years, moving from Sydney to join Oriana in 2017. So over to you, Matt.
Thanks, Stephen. Unmute myself. Thanks, Stephen, and thanks, Janu. Good evening, everyone. Thanks for joining us. Tonight, I'll be speaking through a brief market update on what we saw in 2021. For that, I'll speak to our medium-term outlook for 2022, spanning over the medium term, 3 to 5 years, how we tend to look at markets. Finally, I'll speak to some of the more major markets and where we see some opportunities, and finally, how we're positioning our portfolios at the moment. Firstly here, the global economy has moved beyond the pandemic recession of 2020. Monetary and fiscal support and a rapidly developed vaccine rollout has provided support to allow the world to enter a more durable recovery. Through COVID and inflationary challenges, equity markets continued to deliver strong returns. However, return outcomes diverged across developed and emerging markets. The shift higher in government bond yields also proved a challenge for fixed income markets throughout the 2021 year as well. Equity markets were generally higher in 2021. US equities ended the year 26.9% higher. Throughout the year, energy and real estate were the best performing sectors, up more than 40% globally. Tech and financials increased more than 20%. Australia, US, UK, and major European markets all had double-digit gains for 2021 as well. The MSCI World Index finished over 20% higher. Chinese equities recovered some losses in December, but still ended the year more than 5% lower. Hong Kong equities continued their hit from Chinese regulatory crackdown and capital outflows to foreign countries as well. From the view of interest rates, the Bank of England was the first major developed central bank to hike rates, and other developed central markets are now trimming stimulus as well. With relation to corporate debt, credit spreads broadly narrowed in both the investment grade and high yield space. Corporate earnings were strong throughout the year and default rates still remain low relative to history. In China, however, as Janu mentioned, property developers have faced a number of downgrades from international credit rating agencies amid the Evergrande crisis. The challenges appear to be largely contained to Chinese and Asian high yield equities, as the US high yield equities spreads largely reversed all of the weakness from November to end the year more than 50 basis points tighter. In terms of the USD, this has been supported by portfolio flows into US equities. This, as well as expectation for the Fed preparing to hike rates sooner than other developed central banks. The broad US dollar index has gained more than 6.4%. On to commodities, inflation in December was 7% compared to years earlier. I think the fastest pace since 1982. Oil prices have contributed to higher inflation, with Brent oil ending the year over 50% higher. As we move into 2022, the economy is moving from, as mentioned, a recovery phase to a more mature mid-cycle phase. While the economic outlook is uncertain, there are many risks, as mentioned by Janu. The pathway for global markets depends on how these economic fundamentals play out. In the medium term, the growth of real income depends largely on productivity growth. We expect productivity to help contain inflation in the medium term. That will allow real wages to increase without adding to above target inflationary pressures. That should be, in our view, supportive of ongoing economic strength over the medium term. With regards to interest rates, we expect hikes to begin in 2022, continuing throughout the medium term. We expect this will be a sign of a more capital investment-led durable recovery is now underway. Although global markets were bashed lower last week, we see this as a short-term correction. News that the US Fed has shifted to a more hawkish policy stance has definitely weighed on global equities. The Fed has indicated that its policy normalisation will be faster than probably previously signalled, and this has really weighed on equities. Although COVID-19 cases have soared to record highs in many developed economies, obviously from what we're hearing, evidence suggests Omicron is less deadly. Policy responses have varied through lockdowns to restrictions. However, while uncertainty remains, investors, we feel, looking through Omicron, and sentiment has improved globally, which will continue into the medium term. Our views, although there are a lot of risks that investors are now more aware of, we remain optimistic on major developed markets, including US, Australia, Japan, and the EU, that we can see high single-digit to low double-digit returns annualised over the medium term. Finally, we think it is important to remain exposed to value and cyclical sectors, including small cap. This rotation can continue to play out in the medium term with good portfolio management. So I'll dial in on some specific views for major equity markets over the medium term, and I'll start with the US. The Omicron variant continues to pose a near-term risk to economic recovery, and policy responses have varied across different states. Inflation continues to soar, indicating that some price increases could be persistent, and the Fed now expects 3 full rate hikes in 2022. However, headline economic activity has remained positive over 2021, and we see this continuing into 2022 and over the medium term. This, supported with the labour force now close to full employment and unemployment continuing to fall, will continue to support market growth. Therefore, our view over the medium term is that we think the US recession has given way to a more durable, self-sustaining recovery. The Omicron variant may cause some delay to economic recovery where the lockdown measures are reintroduced, but we don't expect it to derail growth. We think the US will continue to remain a key driver of the world economy in 2022. And we believe earnings growth will continue to drive growth in the US stock market. Our view is that this will typically be supportive of high single-digit and low double-digit returns annualised over the medium term. In Australia, the labour market data showed the Australian economy continues to grow. The RBA has also pushed back on market expectations for a rate hike, although as Janu mentioned, we'll likely see these come through in 2022 and 2023. Omicron cases have surged to new highs in Australia. Most borders have remained or have gone through reopening, allowing for greater travel and economic activity. The vaccine rollout has obviously increased in recent months as well, sitting at around 90% vaccination. With this economic data, we have increased the attractiveness of Australian equities on an absolute and relative basis. And we do have a really high conviction that the ASX at the moment, we feel it is very undervalued. This in turn offering, in our view, significant upside over the medium term. So although we expect the housing market to cool as mortgage rates increase and lending standards are tightened, we do still see a solid economic recovery through 2022, which will be likely led by wages growth and household spending. Therefore, we think that Australian equities offer good return opportunities over the medium term, again, likely offering high single-digit returns to double-digit returns over the annualized over the medium term. So on to China, this is an interesting one. It comes with its risks. However, we do feel that there is quite a lot of opportunity given how much the Chinese market has underperformed on a relative basis. In a broad sense, the COVID-19 strategy has really weighed on the domestic economic output activity. It's lasted longer than I think most people would have predicted. Industrial production has slowed. Manufacturing has also slowed. This has all dragged on GDP, grinding lower. China also faces headwinds with Omicron breakouts, having triggered citywide lockdowns across the country. However, we do expect Chinese authorities to support the economy through 2022. Recent policy easing suggests that Chinese authorities have already started this process, in our view. So from a market perspective, again, just how much Chinese equities have underperformed global equities throughout 2021, we feel that the Chinese market has overestimated the extent of the slowdown, and we feel that equity markets have fallen too far. Therefore, we do feel that at the moment, equity prices somewhere between 15 to 30% undervalued, which in turn offers significant upside market potential to overshoot. So our outlook, earnings growth is still strong, indicating markets are pricing a very pessimistic outcome for China. However, we expect, as mentioned, further fiscal and monetary policy will support markets, again, state-led, and with the recent weakness providing a lot of upside potential as well. So finally, on to Hong Kong. In our view, Hong Kong, while obviously a relatively smaller economy, but highly relevant to us here in Hong Kong as well. But just from an opportunity perspective, Hong Kong has yet to enjoy the big post-COVID reopening, yet domestic demand has driven a resurgence in sales growth, albeit from a low base. This is despite visitor arrivals being virtually at zero. Hong Kong's house prices were impacted by the pandemic, but by less than anticipated, given the impact on travel and unemployment. And GDP growth has started to recover from a deep recession. Therefore, our view, we think the Hong Kong equity market is potentially now up to 40% undervalued. That provides obviously potential for really strong double-digit returns over the next few years, not without its risks. But our view is that there is quite a lot of potential upside here in the Hang Seng. In terms of the fixed income space, we don't think that Omicron will derail the global recovery, but it may delay the full opening, obviously. We think inflation is likely to be at or above central bank targets in the US and Australia over the medium term, and we're expecting obviously rate hikes. Frankly, in our opinion, sovereign debt's probably going to get bashed this year. So from an asset class level, we're really underweight due to relative to our strategic asset allocation, if not removing it from a lot of portfolios. US Treasuries and bonds are offering similar low, medium-term returns. From a corporate credit perspective, we are seeing positive data indicating a robust economy recovery, providing good backdrop to credit markets in 2022. We think Asian credit will offer returns compared to developed market credit, but this does come with significantly higher risk as well. Similarly, we think that high yield credit offers returns moderately higher than investment grade, but again, higher risk. So in our view, we're recommending to overweight investment grade credit relative to sovereign. We recommend remaining somewhat neutral on high yield credit, although it's playing a role in portfolios at the moment. So again, I think it's just important to reinforce that in this space, it is really important to have the right managers in place. But you can see, particularly in the investment grade space, 3 to 4% returns over the annualized over the medium term. So yeah, just finally to tie in how Oriana are positioning our portfolios from a dynamic asset allocation perspective. This bar chart broadly represents our current portfolio weightings based on current attractiveness and views over the medium term. The colour represents strength in our conviction. Black is strong, blue moderate, with white being low. So in the equity space, as you can see here, we've got really strong conviction around the Australian and US equity markets being moderately attractive. We've actually recently upgraded the Aussie in line with that as well. To a lesser extent, Japan, China and Europe, although China has, we feel, increased somewhat in the attractiveness rating. Again here, just being mindful of the risk and return, the more developed economy or markets overweighted from a portfolio positioning perspective. Within the fixed income charts, this is relative to the fixed income asset class rather than being compared to other asset classes as a whole. While we have a positive outlook on growth, diversification across asset classes is important, particularly for those with less than a high risk, high growth risk profile. Although at Oriana, we utilise weightings towards alternative asset classes within the fixed income sleeve. We have rated sub-asset classes of fixed income grading within our portfolios. Further to, as I just mentioned, we feel that sovereign and treasury grade fixed income will be based a lot lower, and we've really underweighted within the portfolios and within that fixed income sleeve. Again, within the fixed income space, we're recommending to be overweight to investment grade, to a lesser extent, high yield. And then just finally, in terms of currency, our outlook, we expect Asian currencies, as well as the Australian dollar, will benefit from a recovery in the China economy after growth has stalled in 2021. For US dollar investors, we recommend a bias towards unhedged positions for international equity exposures, particularly in Asia and European regions in line with this. For our Aussie dollar investors, existing international equity exposures should be at least neutral hedge settings with a bias towards overhedged. And then finally, we recommend hedging all international fixed income exposure. The volatility currency relative to fixed income leaves portfolios exposed if those currencies aren't hedged. That sort of ties in the final piece for me and how we're looking at portfolios over the medium term, and with a skew towards what we're looking at in the shorter term as well. I think we're holding our questions for the end on this. So at this point, I'll pass over.
Okay, thank you, Matthew. So it looks like we got a few questions come through, but we are going to hold it off till the end. There's one more presenter, panelist. So yeah, we'll hold. We've got those few questions in regards to some property, Jeremy Grantham and stuff. So we'll get those answered after the next panelist comes on. So finally, I'd like to introduce to everyone Andre Mudigdo, who's also a senior wealth advisor at Oriana. He has more than 20 years of financial service and banking experience. Prior to joining Oriana, Andre was most recently a senior financial advisor at BT Financial Group, which is also part of Westpac back in Australia. And yeah, he's basically from Sydney. So Andre, can you take us home, please? Thanks.
Thanks, Dave. And thank you, Janu and Matt, for providing that really good snapshot of the current investment landscape and economic landscape and what to look out for, and what's certain to be another eventful year market-wise. What I'd like to do in the next 10-15 minutes is to actually do something a bit different and look at some practical tips really in when you think about your own financial position, and go through some sort of a health check where you are at the moment, and as well as what you have currently in place and how are you moving towards targeting towards your plan. The goal here in doing this exercise really is not to come up with immediate solutions, but rather a considered approach in understanding your position, where you're at, identifying any gaps that you have and how everything actually fits in meeting your overall plans and aspirations, if you like, of working, living overseas. As Matt and Janu has noted in the previous section's presentation, is that we're living in an ever-changing environment. Things can actually change very quickly. And this makes it difficult for us living overseas, especially, to keep some structure in trying to make the most of our time here. So I guess hopefully the outcome of my 10-15 minutes is for you to have a bit of a think and implement some of these practical tips in understanding where you're at financially and having a plan going forward. So what's the plan? Really, this plan is divided into two main things. One is your high-level aspirations. That is, if you actually sitting down after a day's work and actually go, okay, I've been overseas for this amount of time, what have I achieved? What does the outlook going forward look like? What type of experiences I'd like my family to be in? That's the high-level thought bubbles, if you like, that I'd like you to have. So one of them, or a few suggestions, would be considering things such as, how long will you be overseas for? Is there actually an endpoint? At some point, will you be going back to Australia or your country of origin, if you like? Or is this time overseas going to be extended indefinitely? In my experience and Matt's experience as well, we have clients that are really seriously considering this point due to the nature of the current COVID environment and lockdowns, and I guess particular policies, which different playbooks, if you like, in managing this COVID situation, especially here in Hong Kong. Having a think about how long you'll be overseas for would be quite important in laying down the next steps going forward. Tied into this is, when would you like to retire? For a lot of you, this is probably a very long-term question, but it's an interesting one as well. It comes down to your view of when you'd like to down tool from work, when you're going to enjoy the fruits of your labor, if you like, and what that setting looks like. Because for both of those questions, if the answer is going back to Australia, then tax becomes a consideration. Because remember, depending on whether you're a non-resident or a resident, your income will be assessed differently back in Australia, and you'll always be a resident somewhere. In most cases, returning to Australia might mean paying more tax. But for instance, if you'd like to retire in Australia, there are strategies that we can put in place to make sure that you retire with the lifestyle that you want and with the least minimal tax treatment there as well. So those are the two main things from a timeline perspective that you need to get your head around. For those of you which have children, children's education cost is probably having a big presence in your cash flow at the moment. I personally know this from personal experience. So what does their pathway look like? Depending on how old they are, they planning to return to Australia for their tertiary education, or are they going through private schools all the way through? So that is a main determinant as well of your plan in terms of what your children's education path looks like. The next one is a bit morbid. What happens if something happens to you at the moment? So if you take yourself out of the equation, God forbid, what does your living expenses look like? What are the chances of your family maintaining their lifestyle expenses, both either here or when they return back to Australia? And how is that really impacted? So those are I guess the main big ticket items, if you like, when you are considering your current financial position. This then delves into having a good understanding of exactly where you are from a financial standpoint. So from a financial standpoint, so if we move from those high-level items of how long will you be overseas, when you'd like to retire, what your children's education pathway looks like, we're now looking at your current financial health check, understanding exactly where you're at from a financial position. This includes questions such as, and I'll go through each of them in greater detail towards in the next few slides. The first one is things such as understanding your cash flow and what you already have. Are you across your receivables and outgoings? Do you have a plan for the surplus income? What are you doing it with? Is it going straight to lifestyle expenses, or are you actually saving a bit? In terms of wealth creation, do you actually have investment? The things that Janu and Matt spoke about, usually they're implemented or expressed in and in managed funds, for instance, in the form of managed funds or direct shares, for instance? Do you have those type of investments in play? Do you have any savings plans that you actually put away for a rainy day type of thing? What is your cash buffer? Wealth protection would talk about insurances, and do you have any insurances currently in place to protect your family if anything does happen to you? Retirement planning. Do you have superannuation in Australia? When was the last time you checked your superannuation statement? Are you comfortable in what's it invested to? Estate planning, and I'll go through each of these points later on as well, but estate planning is also equally important. When you pass away, do you have a clear picture of what those assets that you've accumulated and where are those going to be channeled to? And do you have assets both overseas and in Australia, and how would that be treated? So we'll go through very quickly each of these points, and just to give you some practical tips on what to look out for. In terms of wealth creation or investment, some of the things that you need to think about, is it held in Australia or is it held overseas? Clearly, the main determinant there is the tax treatment, right? If you decide to sell down on your portfolio, what's going to happen? Is there going to be a tax liability currently when you're overseas? For instance, Hong Kong doesn't have a capital gains regime at the moment, so capital gains isn't taxed. However, but if you do sell down your overseas portfolio when you are an Australian resident, then there'll be a tax component there that you need to think about. So you need to have an understanding of what the tax position is of your investment portfolio, whatever that looks like at the moment. The second part is, can you access it in an emergency? If you need liquidity, if you don't have enough cash, for instance, for something, for an acquisition or an emergency, can you actually sell down your portfolio? Is it locked in for a long-term period, or are there any penalties if you try to liquidate from it? Are you monitoring your returns? Different asset classes would provide different types of returns. Now, is this in line with your expectation? Is the investment actually too risky for you given your current risk profile? So these are the type of questions that you'd want to think about when you are looking at your current investment portfolio. This ties in again to your asset class, right? Whether you have property in Australia, an equity portfolio overseas, or term deposits, what type of asset class does it fall into, and are you diversified enough? The old adage, right? Don't put all your eggs in one basket. I know it sounds quite something that your grandma would say. It holds true for investments as well. Are you diversified enough across the asset classes to have a risk managed type of approach in terms of returns? Moving on in terms of the checklist is retirement planning, specifically superannuation. Do you have superannuation in Australia? This is an interesting one because for those of you that have been overseas for quite some time, you might only have a small balance or something that you didn't really attend to prior to you starting your journey overseas. But for some of us that has not been in overseas for that long, you might actually have quite a significant superannuation balance. So the things to look for there in considering your financial position is to review your investment option to see whether the investments, the funds that's invested in is aligned to your expectation, and whether going forward anyway, given what Janu and Matt has spoken about in terms of investment outlook and economic outlook, it's in line with what you'd like to do. Can you actually consolidate? For those of you that actually have, super funds in different places in Australia, is there an opportunity to consolidate? Confirm your preservation age. And again, I'm alluding to those that has actually been overseas for quite some time. Superannuation legislation has evolved quite significantly in the last few years. One of the things that they have changed is preservation ages. For most of us, it will be the age of 60 that we'll be able to access our superannuation when we do retire. However, having said that, depending on your date of birth, you might be able to access it much earlier than that. But for a rule of thumb, it'll be the age of 60 before you can actually access your superannuation. Some of your superannuation will have inbuilt insurances. Review your insurances in your super to make sure that it's aligned with not only what you have outside super, but also your employment insurances. Those of you that overseas, I understand, will have insurance packages as part of your employment arrangements. See if these insurances in your super actually align to that, or is it just a doubling up of insurances that you don't need? Beneficiary nomination. Have you nominated someone to receive your superannuation and the insurances inbuilt in your super if you pass away? Make sure that you update the details, making sure that it's in line with who you want to give. I've seen too many examples on how this hasn't been updated. You still have former partners, which will be awkward in terms of being nominated as a beneficiary. So just make sure that you're across this. Making contributions. You can still make contributions into super even though you're overseas, and sometimes it actually makes sense from a tax perspective. That's something that we can actually investigate later on as well. And contact details. You'll be surprised how many people that are overseas fail to update their contact details and still have their Australian addresses for any communications from the super fund. Insurance, in line with, I guess, the health check, it's an important one for you to have a look at. Do you still have insurances in Australia? And have you actually given thought about whether it's still appropriate for them, for you to have them, given that you're overseas, or whether they will actually pay a benefit or some insured if you are overseas? The triangle on the left actually reflects the main insurances that you should have or should consider. That includes income protection, life and disability, which is a lump sum amount if you pass away or you be permanently disabled, critical illness, which is a payment that you'll receive if you suffer specific injuries, serious injuries, and medical insurance. Assess your current insurance needs, both here and overseas, to see whether that aligns with your needs and whether your needs have evolved. You have children, your children have now graduated, and so won't be dependent on you anymore, those type of things. Specifically for Australians that have insurances in their super, make sure that there's a balance in your fund to avoid loss of any cover. There has been recent legislation in which if you have a small amount of balance in your super and you do not elect to have insurance maintained in your super, they will actually automatically switch it off, which might be a bit of a shame if you have insurances there for quite some time. In line with that, making sure that you understand the conditions of holding cover inside super versus outside superannuation. Again, with COVID-19, current Australian insurance are selective in offering cover for Australians overseas. So consider having local coverage, especially if you're going to be overseas for quite some time. The last vote, but not the least, is estate planning. Making sure that when you pass away, you are comfortable in what assets are going to be included in your estate and where it's going to be channeled. This is probably the most attended to, if you like, of the financial planning pillar, and you'd be surprised how many solicitors don't even have updated wills. So just have a think about the position of your assets. When you pass away, do you have assets overseas, for instance? How will they be treated? And you're comfortable with your will itself, whether you have the person that you want to have control of the estate does have the right instruments, and what your proceeds will be used for: clearing debts, to protect your family, and making sure that there aren't any much tax leakage, if you like, from the estate when the estate does get the proceeds to channel to the different beneficiaries. So the goal really of all this, of doing this health check, if you like, is not to come up with immediate solutions again, but to really having a good understanding or a thorough process of going through what you currently have, having an understanding of what your long-term aspirations are in terms of being overseas, returning to Australia, retiring somewhere. And I guess then the next process really is to either implement your own plan or to have a conversation with Matt or myself to assist you in identifying your goals and looking at gaps and putting a plan in place. So that really is it for me. There'll be a question and answer session at the end. So I'll hand back to Steve.
Thanks, Andre. That's really great. So that actually wraps up the presentation part of the webinar. We really appreciate you staying and learning all this information. It's a lot to absorb, especially after a long day of work, potentially children at home learning with you. So we'll just give you a few minutes just to submit any questions that you may have. And we also just want to let you know that we're now finalizing next month's webinar, and details of this will come shortly. To make sure you don't miss out on any future webinars or expat finance news, please follow us on any of the social media options you can see on the screen. All the contact details of the panelists are all present on the screen. So let me have a quick look. So yeah, so for February, the topic will be on foreign currency with our friends at OFX. So they'll come on as a panelist to present. So stay tuned for that. So it looks like we've got a bunch of questions. I've got all the panelists up now. So I'll just pick a few of these questions now. We've still got about 5 minutes, but we'll probably just run over about 10 minutes. It looks like there's about 10 or so questions. So looking at the questions, the first one I'll put to someone's asked the question, do you agree with Jeremy Grantham? So I'm not really sure. I had to check with Matt and we're not sure who that is. So I believe the answer. So I'll let you take that question.
I did a little bit of a cheat. I didn't know what Jeremy Grantham has said, but I did just do a quick Google of what he did say. So I'm assuming that the question's referring to his prediction that US equities are in a super bubble and are down 50%. That is as much as I've read. So I'm not sure what more is going into his view, but my view would be that US equities were looking for a big correction at some point in time. It's worth bearing in mind that the S&P as of last week, over the last week, was down 10%. And the NASDAQ was down over that. Now, I personally would still be negative US equities, although I'm not sure if Matt or Andre would agree with that. I think maybe they'd like to comment.
Yeah, sure, I can come in. So yeah, in our view, we do still see continued strength over the medium term for US equities. It has had a correction last week, obviously, as we're all quite aware, but given the continued strength in earnings, continued opening, we still see a lot of strength in the US market. Again, looking short term, it's very difficult to forecast what may happen. We're certainly forecasting a lot of volatility, particularly with interest rates being hiked throughout the year. However, over the medium term, and again, it's the way that we look at this is we look out over 3 to 5 years, we still see a lot of strength in the S&P. And in our view, we still feel there's high single digit to low double digit returns, again, annualized over that medium term. Mindful of volatility, but that's our view.
There is something I do want to add, is that in his prediction, from what I read, he said down around 50%. Now, I think when you look at this correction now, it's occurring on the back of the Federal Reserve just beginning its tightening cycle. So I think it might be a bit early. I'm not sure if it's the right time to be calling for large scale corrections or bear markets at this time. And I think normally when you're looking at these really sharp and large declines in equity markets, it's in reflection of a really sharp deterioration in the economic outlook. And I don't think we're really seeing that. Yes, there's a lot of risks that we need to watch out for, but in terms of recession risk, I can't really see a really strong basis for that.
Okay, so hopefully that was answered for you there. So we'll move on to the next question. We've got a question here. How do you think the rising interest rates versus COVID situation is going to affect property prices over the next year or two? So with the property piece, obviously Jason isn't here to be able to answer that question. He's more than happy to field any property related questions. I'd also draw your attention to a presentation which was done in November by Tim Lawless from CoreLogic. If you'd like to get access to that webinar that we did, that Jason hosted with Tim, that would be a way to learn more about the property price. I'll pass, so to answer the actual question, I'll also pass it over to Janu just to answer that question as well.
So with rising interest rates, it does mean that we would expect some moderation in house prices, but not just yet. I think that we're seeing house prices still increase, and I think we could see that house price growth would continue at least for perhaps the next 6 months or so. But I doubt we'll see as strong a growth as what we saw last year. We're looking at maybe some modest gains instead of like your plus 20% annual growth. We're not going to really see that from here on now. Looking further out and the RBA looking to tighten rate, I would expect to see some sort of correction in house prices. Not a big one, but maybe on the order of 10 to 15%, but not for a little while yet. I think we're talking maybe later on this year or maybe even next year. And along with high interest rates, you have some long-term fundamentals which are not so favourable, being falling rental yield and also like low population growth. It has been super weak now that borders have been shut. That can turn around if they do open the borders, but I don't know when they're going to do that.
Okay, so there's actually a follow-up question from this as well. And the question is, any thoughts on Hong Kong property prices? So I'll throw this question over to Matt for him to put his input into that.
Sure, thanks, Stephen. Property, not really as much of an area of expertise as markets and portfolios. We do have a view on it. I guess looking at 2021 and previous years since the pandemic started, property price in Hong Kong have probably not fallen as much as the general sort of consensus would think. And again, prices have held on, if you will, and that's with little to no stimulus from China, with no visitors coming in, obviously restrictions on travel and everything else. And yes, that stimulus lacking still. Our view is and again, it's uncertain with when the reopening may occur, but with our view, with that reopening, that will support Hong Kong property prices. I guess just outlining potentially some of the risks there outside of fiscal and government policy is the fact that monetary policy in Hong Kong follows the US. There can be misalignment there with interest rates increasing in the US, which may fall out of kilter with Hong Kong. So that could detract or suppress prices in some sense. So broadly, I would say it's favourable, but not overly. Hope that answers that question.
Thank you, Matt. The next question that's been posted: can an Australian will cover overseas assets? So I'll pass it over to Andre to answer that one.
Yeah, sure. Thanks for that. As I mentioned, the estate planning side of things is one that's often not too much talked about. In terms of Australian wills, the question really is, if you do have assets overseas, is whether the overseas jurisdiction would accept, directives from a will from another jurisdiction, if that makes sense. I have seen wills that could be implemented in different geographical areas. So for instance, if you're Australian and you have an asset in Hong Kong, there are wills that can attend to that. But to be on the safe side, what we do recommend is you do consider having separate wills in separate jurisdictions, just to have that certainty, if you like, of that your wishes are going to be implemented by the jurisdiction that those assets are in. In summary, it may happen. You might get a will that is able to be received elsewhere. However, to be absolutely certain, consider having a separate will for separate assets overseas.
Fantastic. Thanks, Andre. Okay, so the next question, someone's asking just a general question relating to USA. Is there an actual American debt problem? And if so, and if not, how is the US dollar so strong? So I'll pass that to Janu. Thanks.
Okay. I'll address that first part of the question first. So I'm assuming that the reference is in relation to government debt and the increase in government debt that's occurred, that is occurring with a huge amount of fiscal stimulus, and I guess like US debt as a dollar amount and even in percentage terms of GDP was maybe high by historical standards and maybe close to getting to 100% of GDP. So yes, look, it does sound high compared with historical standards, but when it comes to debt being a problem, we don't actually know until maybe it's too late. The fact that interest rates have been so low for so long, and with not much inflation to be seen for many years, it was a real justification for, look, when you have low interest rates, you may as well use that to invest into the economy. So there was actually a real switch in economic thinking about what is sustainable debt for a government. And the shift was, rather than as a percentage of GDP or as a proportion of the economy, it shifted to what is the GDP growth rate of that economy. And if that GDP growth rate was stronger than the interest rate, well, then the return on your investment into that country is going to be sufficient to pay off that, to service that debt. Given that, look, growth rates have been sort of skewed by COVID. Certainly last year, we're looking at very strong rates of growth. So not sure if we can really count that, but say on average, like potential growth, maybe 2 to 3%. Interest rates actually, bond yields are potentially actually rising that much. Maybe the question might be raised once again if that kind of debt is sustainable. So I think it's probably something that they can probably kick the can down the road and maybe address it for another time for a bit more. Having inflation in the economy does change that story a little bit. Perhaps questions will be raised about it a bit more at a later time. Coming back to the idea of when debt actually becomes a problem is when investors aren't going to lend to that country or whoever. When they stop doing that, when they lose confidence in investing into or lending to whoever that is, anywhere near close to that, because the US is still, and the US currency is still the reserve currency. There is that natural tendency to still invest in that. We don't have a market equivalent of US treasuries where people just need to put in their money. And so coming back to the question, coming to the second part of the question, which was why the US dollar is so strong. And why, I suppose recently that's in reflection of inflation being quite high. And also the US central bank is looking to increase interest rates, and they are probably not the first. There are other central banks which have moved. The other majors, which actually are very strong determinants of the US dollar in itself, is like such as euro, yen, their central banks are not looking to move, and they're further behind in terms of raising interest rates. That's why I'd explain that US dollar being strong. And yeah, look, a little bit of a wishy-washy answer, but I think it's more about a guide to whether it actually is a problem, and that economists don't actually really know exactly what that point, that threshold is for what government debt should be.
Okay, thanks, Janu. That was a lot to absorb. Just as a reminder again, this is being recorded, and we'll send you the link to the recording so you can re-listen to Janu explain that. But talking about inflation, someone wants to know what are your thoughts on gold and whether it's a good hedge against inflation. So I'll pass it to one of the gentlemen here. Whoever wants to take that.
I can take it. So in our view, gold is a speculative asset. There's no income stream attached to it, so it can be challenging to derive a fair value. So in our view, we don't feel that gold is a great diversifier or inflation hedge for a portfolio, given the fact that it tends to exhibit equity-like volatility with bond-like returns. They can also be positively correlated to global equities in some case. So while we don't feel it's a great inflation hedge, inversely, in the near term, we do actually have a favourable view, or potentially favourable view. There are a number of driving factors that may support that. China and India are two large countries for gold jewellery. So with consumption normalising, festive activities resuming as time goes on, demand for gold could improve. Further to that, given there's no income stream attached and it's not priced in the same way that we do equities, demand tends to drive this asset, given it is a speculative asset and given there is a lot of uncertainty, particularly in Q1 this year with rate hikes and etc. We feel demand may actually push gold higher in the near term. However, over the longer term or medium term, as we tend to look at it, we don't feel it's particularly good hedge against inflation.
Okay, thanks, Matt. I've got another question here. Can I still contribute into super even if I'm a non-resident and I'm living overseas? And I guess just for me to add, how would someone go about doing that? To pass to Andre, that's okay.
Yep, thanks for that. Yes, the quick answer is yes, absolutely. You can contribute into superannuation even though you're overseas. Superannuation legislation doesn't have any jurisdictional requirements. You can be resident, non-resident, living in Timbuktu, doesn't matter. In terms of the logistics, it's better to make sure that especially in this day and age, it's going to probably involve an EFT transfer of some sort. So make sure that you liaise with your superannuation fund first and foremost, and make sure that they are cool to receive overseas transfers if you have an overseas bank account. That was one of the issues that I was helping a client with. And also make sure that if you are going to make contributions, that's either in line with the contribution limits, as there are limits on how much you can contribute from an after-tax position, or you want to claim a deduction. The recommendation is to get your research done early, making sure that you've got all your cards in place prior to the contribution, where to contribute, the bank account details of your super fund, and if you are going to claim a tax deduction, to provide the fund with that information before the end of the financial year.
Fantastic, thank you, Andre. So just mindful of time, there's 2 more questions. We'll answer those 2 questions and we'll wrap up the session because I'm sure everyone's a little bit tired. So this is a question which I guess I'm also interested to hear more on, and open to anyone who wants to answer it. What are your views on crypto? So quite an open question. Does anyone want to take that question? Or just to add their 2 cents, anyone feel free to unmute and answer that question or contribute.
I can start if you like. So in terms of views, what I'll probably speak to is how we look at it from a potentially a portfolio perspective. Similar to gold in a sense that it can be a speculative asset. There's no income stream. Crypto can't be priced like by looking at future earnings, for instance, and the typical way that we price traditional markets. So again, it is really difficult to try to derive some sort of fair price, future price forecast. Without being an expert in the area, it's almost purely driven by demand. That's difficult to forecast. So when it comes to how that might make up an allocation in a portfolio or someone's overall wealth exposure, it can be viewed as a true alternative, cryptocurrency or that asset class in particular. So it can be a diversifier. However, the downside risk, unlike traditional equities, is basically 100%. Crypto can fall to zero. Unlike if you're buying the S&P 500 or the ASX from a very broad-based index approach, you're not going to see the markets fall to zero. You're basically seeing the economy crash in that sense. So we tend to view it as having a higher downside risk than traditional markets. However, the upside can be anything in this space. Again, it's just a very highly volatile speculative asset. That's the way we look at it. In terms of views, probably withdraw on that sense. So unless anyone's got anything else to add.
I'll just add to what Matt, in terms of crypto, the way I look at it is 2 things: liquidity and also your risk profile, right? If you are quite aggressive, if you have a really, out there risk profile growth, you don't mind, again, as Matty said, having an asset go down to zero. However, you do believe and you have a lot of conviction in terms of the upside. I do think there is a place for crypto, but obviously make sure that you are 100% clear that from a liquidity perspective, it's not going to be an asset that's easily accessible, and that it should really form a very small part of your risk bucket, if that makes sense. So again, the considerations are, if you are pretty aggressive from a investment risk perspective and you do have major convictions in terms of the upside of this asset class, like anything else, make sure that you invest into these things with your eyes wide open, really.
So I want to say something about Bitcoin in particular. And I think that the emergence of and the increase in demand and interest in cryptos has really emerged from a long-term structural decline in the US dollar as a reserve currency. So there has been a real long-term flow of, okay, the US as an economy is not as a big proportion of world GDP as much as it used to. So in terms of US dollar dominance as a reflection of the world economy, actually does not make a lot of sense as much as what it was. The problem with that is that there's not actually a really good alternative for it. You look at the euro, Europe is just, there's a lot of political concerns about integration of the euro itself in the European Union. And as well as that is just not large enough. The other, you might say yuan, China and yuan, but like that currency is just not interconnected with a financial system, and China's financial system is just not as integrated. So look, I think it's just about looking for those alternatives, and crypto has just emerged as one of them. The other thing is that we've gone through this period where there's been extremely easy monetary policy. So there needs to be this home for this money to go somewhere. All sorts of assets have gone up in this environment, like whether it be equities, bonds, but outside of those traditional investment assets, like artwork has gone up, used cars have gone up, prestige cars have gone up, like all sorts of things have really gone up in this environment. So there's a couple of factors at play. When it comes to the technology behind cryptos, there's a lot of good things to be said in terms of applying that to payment systems in the future. But as terms as, say, Bitcoin itself, there's a lot of questions on whether that's actually viable as an actual currency. It doesn't actually work very well as the other cryptos. As far as I know, maybe a little bit better, but then you have that question of replication of other things. So yeah, like it doesn't really, to me, it's not make sense as an asset as such, and it is really a speculative.
Fantastic. There was one last question, but it was answered on the side. So just looking at the time, it looks like we've gone over. So really big thank you for everyone for staying up. It's obviously a big commitment, a big chunk of your time. We've hoped that we've been of assistance. Everyone's contact details are present on the board there. So please feel free to contact any of our panelists, and also Jason as well, if you need any more advice or any other further questions. So tomorrow is Australia Day, so hopefully you get to spend some time with some friends, have some steaks, have some beers. Obviously we've got Chinese New Year next week as well. So just want to wish everyone a safe Chinese New Year. I just want to give thanks to all the panelists as well for taking the time to share today. We hope that it's been helpful. And just a reminder that next month's seminar will be on foreign currencies, so please join us for that. But yes, thank you and have a good night. Appreciate it. Thanks. See you later.